Bank.
Welcome back. Well, never count your chickens before they hatch, as they say, and look at the market. Holding on to any sort of a gain is always proving to be difficult. So that every time there's the slightest bounce, 40, 45 points, you're getting sellers come back to the screen. So it's still around that flat line, not going anywhere really. Let's get some fundamental ideas going with Rajesh Baheti, Managing Director of Cross Seas Capital Services. Rajesh, thanks for joining us. It's been a very, very interesting market. You tell us, are you out there with a shopping list of sorts, or are you staying on the sidelines and waiting for this noise to settle?
Typically, at the end of March, in any given year, you will see a lot of books being closed, the margin financing books, or the books that are not disclosed as margin financing, but we all know that they happen, the leverage books, and they all get closed. So there is anyway pressure in March. And come April, I think, new books open. So typically, March is a month to buy and sell in April if you want to do a short-term trade. This time, I think the opportunity is even better because by itself, the markets are weak and there's some kind of capitulation you can see across sectors. Having said that, if you look at the chemical sector, widely, I think stocks are 50% of the highs. So that's one sector I would be interested in looking at to buy in March for a 15-20% pop, if at all.
All right. Hi, Rajesh. Good morning. This is Pavitra. Would you also look to buy the banks? That's a space that you've been positive on for a while, right? So with the kind of correction that we're getting now, would you use that opportunity to add the banking names?
Yeah, so essentially, I think, everybody needs to understand that at the very core, every bank is kind of running a Ponzi scheme, not in a derogatory sense. But the fact is, if everybody lines up at any bank to pull out their deposits, the bank is going to go under because all that money is used up. Some of it is locked up in HTM, which for the time being may not be making money, as is the case with most US banks, with the interest rates having gone up by 400% in a year. In India, the interest rates have moved up by 20-25% because we never went sub 6%, and we are at 7 point something now. So from that point of view, I think the Indian banks are much better positioned, whether it's the sale portfolio or the hold to maturity portfolio. So it makes a clear case for buying some of these Indian bank names that have been hammered down just because a couple of banks had liquidity issues.
Okay, got that. Rajesh, tell us a little more about your thoughts on the FMCG sector. Very interesting sort of trades playing out over here. Till yesterday, there was absolutely no move. That classic rush to safety that we get every time the market goes into a tailspin, that's not really been playing out. Today is a bit of an exception. How would you look at consumer companies, given that inflation is still a challenge, right?
So, consumer companies historically have been priced much higher than their global peers in India. And it's always a difficult call whether you should buy these companies or not because they're trading at 40, 50 PEs. So one way to look at it is, of course, there's a rush to safety. There's panic out there in the street, and some of these names will get bought into. But I don't think they make a case for investment because I think we're going to slow down in line with the rest of the world, and consumer spending, discretionary spending will also slow down. So apart from maybe some really, FMCG names where the demand is inelastic, and if you want a hiding place, I don't think it makes a case to buy any of these names right now. In fact, some of the other sectors such as banking, chemicals, and industrials are looking much better placed for a buy now for a 15-20% pop.
All right, got that. Rajesh, another space I want to ask you about is the real estate space. This morning we had DLF confirm that they did, in fact, clock in those sales at their Arbor project at Gurugram. So that news piece is confirmed. We have been hearing about how luxury sales for the real estate players have been very strong. The index, of course, is not done very well this year. It's down around 11%. But do you think this space is good to play right now? The entire real estate pack, or at least the luxury players?
So a couple of things about the luxury play, from next year, the tax incentive to reinvest capital in a personal house is going away. So there may be a March rush to lock in some properties, and that's why you're seeing these big ticket deals. So come April, I think this scenario will get rather more challenging. The big problem I find is how to value real estate, because there is a lot of cash component when you're going for clearances, when you're doing all this construction and other things. And towards that, I think some of these companies do have to recover some cash also from their buyers. It's a very, very hard call to make, but I like some of the South-based realtors because traditionally I think they've been far more professional in their approach, and the cash component in maybe southern India is far less than what we see in northern India. So at best, I think Sobha is looking cheap, but I won't make a larger call on this sector because I think just valuing it is a rather difficult task.
Okay, Rajesh, we are in a pretty topsy-turvy market, but I think a lot of people out there are also thinking of medium-term portfolios, not looking at the immediate tomorrow. So for such people who are looking at this market from an investor's lens, would you leave us with maybe a couple of ideas?
So the only idea I leave investors with when they want to build medium-term and long-term portfolios is find a good portfolio manager or find a good mutual fund. Don't try and trade this market or invest in this market yourself, because despite the fact that there has been democratization of information, there is still information asymmetry, analysis asymmetry, and the professionals do a good job of managing your money. So go out there, put your money in funds right now. If the markets go a little lower, get even more aggressive and put more money. But don't try and buy individual stocks. The ideas I discuss here are broad themes, but not really for a long-term portfolio. I think you've got to look bottoms up and find a good portfolio manager.
You know, Rajesh, we were really hoping that you're going to give us some stock ideas and we would take some notes down. But I mean, good advice.
For a pop, I said, the chemical sector has been beaten down mercilessly. They're down 50% from their highs. The banks are pretty solid in India because we didn't have this interest rate rise, which went up by 400%. So for a trading pop, yes, 15-20%, I see two sectors straight away, maybe industrials also.
All right, got that, Rajesh. Very helpful. And thank you for stopping by and speaking with us today on where you see the markets moving, as well as all of these individual sectors. But another important story coming through right now, ICICI Prudential Life Insurance gets a new boss as Buymcg gets appointed as MD and CEO. Yash is here with the details. Yash, the street definitely likes the sound of that.
Well, certainly, and very interestingly, when N.S. Kannan, the incumbent MD and CEO at ICICI Prudential Life, was appointed, he